Hey everyone, thanks for joining me. In this video, we're going to talk about 3 Canadian stocks that I'm buying in June of 2023. If you like this type of content, be sure to like this video. It really helps with the YouTube algorithm, so I'll just give you a minute to do that now. Also consider subscribing to the channel. We're still trying to grow the channel here, so every subscriber counts, and I really appreciate it. Okay, so the first stock that I'm going to be talking about today is Pembina Pipeline. Pembina Pipeline, if you couldn't tell by the name, is a pipeline company. This stock yields over 6%. They actually used to pay a monthly distribution, but it looks like they've recently changed it to quarterly. Looking at this stock over the last number of years, they've been pretty stable. You see, obviously, the drop with COVID, the company actually got cut in half as oil prices crashed. But lots of this business is really on regulated contracts, and the amount of oil that's flowing through their pipelines, they're just getting a fixed percent on the tonnage, not necessarily on the value of the oil that's moving through. So pretty defensive stock as long as oil and gas is being used in society, specifically in North America here. This company will keep moving it effectively and keep getting paid to do so. The stock right before COVID was right at that $50, just over $50 mark, halved overnight pretty much, and then clawed all the way back up. It actually went back up to 50, 52 bucks, but has been trending down over the last year or so. So at these levels, 43 bucks, we're talking about a stock that's going to yield over 6%. Looking at a bit more information on this company, their objective is to grow their EPS by high single digits, 6 to 8%, as you see here on their website, and continue to deliver dividend growth. Looking back, this company has increased their dividend, 3, 4, 5% annually for quite a while. So even though they have a high dividend yield, it doesn't necessarily mean it's at risk or it can't grow. You can really get a sizable yield on cost here if they continue to have the track record and perform as they have recently. Regulated U.S. utility stock. So yeah, lots of their revenues are fixed. Balance sheet they're calling out here as well. They're investing a lot in their infrastructure and their operation, and they do have objectives of trying to be net zero by 2050. So they do have some ESG goals as well, despite the kind of stock that they are. I talked about the dividend, but just wanted to share a bit here. This is even just in the last 15 months or so. They're paying 21 cents a share, went up to 21.75 cents a share. So, pretty modest increase, call it 3-4%. Then they went to a quarterly dividend of 65 cents a share, and then recently just increased it to almost 67 cents a share. So you're going to get these 2, 3, 4% increases, which is pretty nice to get on a stock that's already yielding over 6%. Looking at their earnings per share, expected to make just under $3 this year. So doing that on a price to earnings multiple, we're talking about 14 and a half times earnings for this name. Has some growth to it as well. So very fair valuation on this company, paying a great dividend, history of growing it. It's one that around 40 bucks, I'm really interested in getting involved in it. And it's been on my watch list for a while. So I may start nibbling on this one, collecting that dividend as I try to build it out into a bigger position. The second stock that I'm buying in June 2023 is TD Bank. So TD Bank has had a really rough year with the broader banking sector. They've also had an acquisition that fell through that I want to talk about. They did close Cowen, I'm not sure how to pronounce it, which is more in the investment banking sphere. It was just, I think, $1 billion acquisition. So pretty small in the grand scheme of things, seeing as this is a $145 billion company. But TD Bank is, I think, the 5th largest bank in North America. It pays about a 5% dividend yield. They've also been increasing their dividend pretty much every year for the last 40 years. And then they also trade at under a 10 price to earnings ratio. So this is one that's one of my biggest positions, get a lot of dividend income, a lot of dividend growth from it, and looking forward to continuing to buy it on discount. It's really my bank of choice on the weakness in the sector. So I mentioned it briefly there, but one thing about this bank is they've really tried to use lots of the money that they banked during the pandemic when they weren't allowed increasing their dividend or buying back stock based off of the government of Canada's processes or rules. They banked a ton of money, and they spent that money on acquiring First Horizon for $13 billion. But the deal never went through, as regional banks in the US were crashing in value. The value of First Horizon from the stock market looked like it was closer to half of what TD agreed to pay for it. There was also lots of regulatory barriers in the US. US lawmakers didn't want TD buying First Horizon, such a big acquisition. So eventually it fell through. TD lost, a couple $100 million in break fees probably, along with a lot of focus and attention from senior management that could have went elsewhere. But overall, probably not the worst thing to happen. It's just going to be really interesting on their future earnings calls to see what is their growth strategy in the U.S. now. This would have been a huge pillar of their U.S. growth strategy to acquire First Horizon. It'll be interesting to see if they look at other acquisitions, or if based off their experience here, they shy away from M&A in the U.S. and they really try to invest in organic growth of the TD brand. So that's a really big thing I'm waiting to see on how they kind of take their next step in terms of their growth, because the U.S. is really where they've been calling out their focus to grow the overall business, since the Canadian banking market's more saturated, less players, really hard to get customer acquisition. Going into their business quick, one of the things I like about TD is they're pretty diversified, and they are diversified primarily in elements of banking that are a bit less volatile. They don't have a huge investment banking division and stuff like that. You see here 40% is Canadian commercial banking, 30% is US retail banking, commercial, and then 15% wealth management, 7% through the percentage of Charles Schwab they own from folding in Ameritrade, then just 8% wholesale banking. So really diversified commercial bank across both the US and Canada, trading at a very fair multiple in my opinion. Going to the earnings per share, expected to do $8.30 this year, $8.60 next year. So anything under a 10 PE on TD Bank, in my opinion, is a good valuation. So right now we're trading right around a 9 PE. So I'll take that 9 PE on this bank. That means you're getting 10-11% cash flow yield. You're getting 5% of that paid you in a dividend. The other 5 to 6 to invest in organic growth, other capex opportunities, buying back shares, increasing dividends for future years. So I think the valuation is great. These companies over the long term have done super well at compounding value. So being able to get that 10-11% free cash flow yield, I'll take the 5% to the bank, and I trust TD to create a lot of value for me with the other 5 or 6%. Okay, going into the third stock that I am buying this month. This one may be a bit more controversial, because in the REIT space, these stocks have been hammered lately, never really getting back to the pandemic highs. But even on the year, this one's down, a good 10, 12, 15%, is Riocan. So Riocan is a retail REIT in Canada. They own a lot of flagship properties in major cities. They also own some office space, but we're talking only a few percentage points of their business. And also a few percentage points are on residential, rather, and that's one area they're trying to build up. Looking at this company, they have almost 200 properties. You see their focus areas here, 83 assets in the GTA out of their 190 assets. So a huge part of their assets, and then even bigger part of their square footage, about 55% of their total square feet is located in the Greater Toronto area. Then you see Vancouver, Calgary, Edmonton, Montreal, Ottawa, the big 5-6 cities in Canada. They have like 90% of their revenue coming from. High occupancy rate, despite fears around retail and, a couple of the office buildings they own, but 97.5% occupancy rate for this company. Their recent results were pretty strong. 44 cents funds from operation. They gave a forecast of $1.80 funds from operation on the year. So that was a good soundbite given where the stock's trading. Same property net operating income growth, 3.4%. So as interest rates are going up, cost to serve these tenants and serve interest or debt rather is going up. It's good to see they're getting some organic growth as well as double-digit spread growth on new lease signings. Going into the types of tenants that they serve. So this is one of the common misconceptions with these big REITs. People are thinking like just shopping malls and stuff like that, where lots of those dollars are flowing to Amazon and online. Lots of these big retail REITs that are in like type A assets have very well diversified portfolios with lots of essential tenants. So look at this in terms of the flow charts here. You have 20% of their business in grocery, pharmacy, and liquor. For the most part, this space is really safe from e-com, and if anything, as populations are growing, the need for these centers in densely populated areas are going to continue to go up. Essential personal services like haircuts, lots of these are also blanking on me, but haircuts, stuff like that. Like lots of these things are not going anywhere. Specialty retailers, think Canadian Tire, Dollarama, value retailers. The combination of these four that are pretty essential segments of retail combine to be about, what is that, like 50%, 60% of their rent. You go down here, even quick service restaurants, experiential. These are also, pretty good areas. Some of the weaker areas are apparel, hardware, department stores, furniture and a home to a lesser degree. Some of those may have some risk, but as long as trends evolve slowly, they'll be able to take that space, rent it to whatever kind of retail is required for different sectors of the economy. And overall, I think they should be fine. The absolute amount of retail space per square foot in Canada is way less than in the US. So lots of the empty shopping malls and stuff like that in the middle of nowhere in the US. We don't really have a landscape that will turn into that as easily, just given that we never overbuilt retail in the first place. One last thing, as they keep trying to build out their Riocan living business, I think they want it to be $50 million of funds from operation over the next couple years. They continue to build new buildings here. So they have 10 buildings. These are big residential apartment rental buildings that they have, high end for the most part. They have a 96.5% lease rate in 8 of the buildings that have ramped up. They have a couple more that they're currently ramping up. They've also shown appetite to make acquisitions in the residential space, and I think this will be a great diversifier and stable revenue stream for them that may be able to fetch the stock a higher valuation. So the stock right now is trading at $20 a share, as you can see up here in the top left-hand corner. They're into about $1.80 in funds from operations, which is essentially EPS for REITs. So they're trading just over an 11 times funds from operations multiple. They pay a 5.5% dividend yield. The other half goes into right now between paying down debt, since interest rates are going up. They want to delever a bit, as well as I've seen them do some stock buybacks as well when the stock's gotten cheap. So creating value in a lot of different ways. Relatively stable company. I like it at these levels at just 11 times earnings. I think it has great opportunity to even grow those earnings into the future, especially if they're buying back shares. And I'll take the 5% dividend while I wait. So these are the 3 stocks that I'm looking to buy throughout the month of June. I've already bought a couple of them and added to them in my portfolio, which I can do on another video, but wanted to share this with you guys. If you like this type of content, be sure to subscribe to the channel, give this video a big like, and I'll see you guys in the next one.